let's start with the sell-off in the markets today. What's intriguing to me is so there's a sell-off in software companies, and it's the premise, if you're a seller today, the thesis I should say, is that AI is going to rapidly transform enterprises, and software that seemed very valuable 2 years ago, 3 years ago, 1 year ago, all of a sudden is going to become obsolete quickly. I mean, at least the market reaction, we're seeing Salesforce down 7%, Workday 7%, all the private funds that invest and lend to this stuff, double-digit, 10% type declines. A huge move today. What do you make of this, and is this an overreaction or a proper reaction?
So first, time will tell whether it's an overreaction over the next few years. But what I do know is when you read something in the paper, my one-loss record of now's a really good time to focus on it, and is you have more victories than not. So you're reading about obsolescence, about the fall, the alternative use of that you're going to be able to code with AI today, and that it's going to make the existing software useless. When you're reading about that and the markets are behaving that way, we were talking just a couple of moments ago, what's the probability of within, call it 24 to 36 months, that most software won't be used, or the growth rates are going to be significantly different or negative?
I want you to start with what you think the market is pricing the probability at. What is that?
So I would say it began the year at less than 10, and now it's 20, 30. So 20%, 30%, and maybe 30%.
30% that this is going to be a very rapid transformation.
It's going to be, growth rates are going to inflect. And by the way, the good news is, even if that's right, that doesn't mean there aren't terrific opportunities. In fact, for what we do, and I've been doing this for a while, this is what we get up for. This is so exciting when there's just a broad sell-off.
This is a good day for Steve.
Yeah. Well, it's not that we have all the answers, but there's dispersion. And the idea that all software is the same is what's exciting. And the market is just broadly, people are overweight, particularly in private credit, where it's the largest industry group or subset of an industry group, which is technology and software, is well overrepresented, often at 20% plus of funds. And so there's going to be a terrific opportunity because people want to get down, and we're seeing that. There's just indiscriminate selling regardless of what the prospects are and what the barriers or the moat is for each business.
So when you, what are some of the opportunities, if you can get specific, that you're seeing out there? I mean, we've seen companies like Cloudera, which manages companies' data and data lake. Those companies have been hit. That was just before today, actually. That's in the past, I think, week or 10 days. So what are some of what do you see out there, opportunities?
Sure. So if it has a lot of customer support, doesn't lend itself to just a database screening, something like an LexisNexis, opposed to a legal database, opposed to looking, having a installed customer support interaction, heavy interaction with the customer, that's good. Heavy interaction with the customer is just very hard to just pick up and move. And then there's also is this the right decision, and how quickly can we make that decision? Well, if you have a lot of infrastructure in place, it's hard to make a decision quickly like that. Whereas if it's just a database that's a better database, that's easier. So
you're talking about companies that have to implement this stuff. You're plugging really important software in to replace something else, and you can't just yank it out immediately, right?
Well,
I mean, this is complicated stuff to do.
Well, also, if it's cybersecurity, what is distinct, idiosyncratic, opposed to a broad database? And people say, well, there may be apps that can use the AI functionality. Well, they haven't been developed yet, so they could, but then we're talking about an unknown of an unknown. So so that's one aspect of the business. The other aspect is, well, what looks like it might be challenged, and how's it priced? And we're seeing that those are priced as if they're really have 2 or 3 years left, or 3 times cash flow. And when the way software is, it doesn't require a lot of capital. You can buy some of these senior debt instruments at 3 times EBITDA, and EBITDA minus CapEx is pretty much the same thing. So,
in other words, they're going to pay their creditors is what more than for 2 years is your point here.
well, where you're buying it, because a lot of these are trading in the 50s, 60s, 70s,
Yeah.
that you are given a pretty good head start there.
Let me talk more. Let's talk more broadly about the state of private credit. It's been a hot topic today, and
Yep.
obviously this industry has boomed. And lately, there's been this debate of we all know Jamie Dimon famously reflected on the fraud and the bankruptcies at the auto related auto
Yep.
industry companies, First Brands,
First Brands, yep.
Tricolor. He said, where there's one cockroach, there's probably more. We heard from John Gray earlier that the private credit market is healthy.
Yep.
And other titans of the alt investing world have said, this is all misguided to make a big deal about this. Where do you come down on it?
Sure. So that there are a couple issues here. First is fraud pervasive in terms of did the companies, because people are so anxious to put out money that they didn't really look that carefully, and there was a bunch of first brand type of investments in their portfolios. I'll take the under on that. And could there be a % of the market? Sure. But is it systemic? I'd be skeptical. If you look at was the risk priced wrong? So I'll give you an example that a lot of high growth companies have low credit ratings. So you look at XAI, which might have had this huge market value, was just combined with SpaceX today. It wasn't highly rated because its cash flow is developing, even though it has Twitter, and it just did a deal that would say that that the debt as a percentage of the equity was 10%. So it looked like your loan to value was very attractive. That type of financing is very attractive in private credit, where there's a lot of enterprise value, but not a lot of sales and EBITDA. To the extent that those valuations are wrong, private credit's vulnerable. So that's different than a fraud. It's just, and the reason why it goes to that market is because it's not ratings dependent. If it's ratings dependent and it's CCC minus, that shows up differently in portfolios that are more liquid.
So you don't see an erosion in diligence in the hunt for yield here. You don't see something like that more widespread.
Sure. So again, a different question.
Yeah.
Okay. Fraud is different than careless and more aggressive. There's a reason why it was priced at 50% to 100% of the spread of a high yield index. If a high yield index is 280 basis points over treasuries, that's a different risk profile and a different
pricing.
reward. Yes.
Let's talk about the BlackRock recently took a 19% write down at its BDC, a publicly traded fund that engages in private lending. And the company blamed the poor performance of investments in the fourth quarter of 2025. And our own reporting was that as of November, those investments were at or around cost. So this was a pretty rapid change that caused this markdown. I guess my question is, what do you take away from that? Is there a valuation problem or lack of transparency in private credit that investors should be?
So I'd rather not talk about or discuss that specific fund and talk about pricing transparency. And I feel like that's going to be under a magnifying glass, and I think correctly so. And there should be some standards that people follow. And there's also, when you go to a valuation like an appraiser like a Houlihan Lokey, you're giving them what the projections are. And there should be some sort of responsibility of whether you think those are fair projections and why. Houlihan Lokey is only responding to what you give them. And they may have opinions and ask questions back, but I think there needs to be enhanced accountability and transparency. We see throughout names we have positions in different pricing. And there's some times where we can go, you know what, I understand why there's, just like in the public market, we don't think that the public pricing always would be consistent with what we think the prospects are. But in some situations where it's clear companies have missed earnings by like 50%, that 95 doesn't seem like the right price. And we've seen that on some of the portfolios.
Have you seen any change in behavior in the market, in your world, among credit investors, as part of the fallout from, say, First Brands? Are people...
That's a great question, because we absolutely are seeing, so First Brands, and kind of an anecdote, we were actually looking at First Brands a few years ago, and we asked a bunch of questions. Usually when there's a roll-up, there's working capital issues, so we focused on the working capital didn't really add up to us. So their reaction was, you know what, we don't want to do business, and they put us on a restricted list. And we were it was the only restricted list that we were on, because I checked, I was like, boy, I wish I knew that I would have tried to.
So you asked too many hard questions and got blacklisted by these people?
Yes. And, but in terms of the behavior, because it was pretty much a fraud, or not pretty much, it was a fraud, the dip that people lent to required a lot of working capital that people didn't appreciate to have ongoing operations. So the fact that accounts payable were stretched, they had to solve that to continue to operate, and it turned out to be much more, it took a lot more capital. So that dip went down, and usually dips are perceived to be pretty safe, went down 80% in just a couple months. So that whole market for businesses that are under pressure, that had to file or declare bankruptcy, that dip market, or liability management exercises, which are out-of-court restructurings, where the super senior, which is really the dip of those structures, have come under pressure. So you see something like a Saks, the dip we thought was attractive because people were concerned about working capital issues, and you look at something
which you bought, you're part of the bankruptcy financing, the dip financing at Saks, correct?
Yes.
So you saw a reaction there,
an opportunity
there that sort of corresponds to perhaps some people backing off and saying, I don't know really what's under the hood at Saks.
Right.
Let me leave it to Steve. He's got better analysis than me.
I don't think it was about us. It was about, it was something that the people were like, this isn't what we want to do.
Scary, yeah.
It kind of reminded me of the AT1s, or junior preferreds, in banks after Credit Suisse was sold to UBS. And there was just this knee-jerk reaction where it turned out the Swiss regulator encouraged a return, even though it was a pretty small return, for the Credit Suisse equity holders, and no return for the junior debt holders of Credit Suisse. Now, the Swiss regulator does not regulate most of Europe. That's the ECB. But it turned out that people extrapolated and sold off all the junior securities, and it turned out to be a terrific opportunity. I think here, fraud and the extrapolation of the working capital demands is what this market has now been concerned with, and that has provided a good opportunity.
Well, we're running low on time, so I want to ask you about the Fed. Obviously, it has a major bearing on your business. Sure. What happens with the new regime here? What do you think about? What are you expecting from the Kevin?
I think Kevin. We know Kevin well. I think he is the perfect choice. He's a very good listener. He's pragmatic. He understands markets, and I think he's a terrific choice. To the extent that you're also, or as we see how good somebody is once you have volatility, whether it's, for instance, the great financial crisis, 2008, and what Bernanke did and how he responded, which, Kevin was part of Bernanke's Fed. So I think his background's terrific, and I actually thought it was a great choice. I was quite pleased.
if he follows through on, if he follows the path many expect him to take, shrinking the Fed balance sheet,
Yep.
and it appears he's struck some dovish notes on rates, what would be the upshot for your business?
I'm not so sure that it makes it a terrific buy because I think that there are some aspects of returns that are going to overwhelm what the Fed does. So, for instance, if you look at spreads now around 280, it's borderline fourth quartile of valuation. So right now, values are pretty poor. And when you have values poor and the economy is expected to do well, over 2%, returns historically have been mediocre in credit. In fact, in high yield, below investment grade, where we do most of our investing. And as a result, the estimate for us would be that you would have return to lower than the coupon, call it 5% area. If the economy, though, if it slows down, starting with this valuation, and the expectations for the economy being pretty good, then watch out. Returns have been significantly negative. So when we think of the skew of returns, it's not great. I don't think a good, talented head of the Fed, Fed chief, is going to change that.
But you love him.
Well, it's, you always want to have somebody who you think is talented, in a responsible role.
Before we wrap here, I just want to ask you, you were an early, if this Wall Street South migration, we'll call it.
Yes.
You were early on that a couple of years ago coming down here. Do you foresee that gaining momentum from others you talk to, particularly with the New York mayoral administration? Donnie, I mean,
Sure.
we've heard a lot about this. We haven't seen a lot of action yet, but I'm sure you're in these conversations. What are you?
Sure. So the product is a great product. I met my wife on the beach in Palm Beach 35 years ago. So and we've had a place here for over 30 years. So it's been a place that we're very very comfortable. But seeing the growth, seeing the connectivity, seeing the engagement of people, and all the events such as this, it's exciting, and I'd expect it to continue to grow.